Hello everyone. Today we will understand what is fraud, what are the various fraudulent behavior and their prevention in business. Let us understand what is fraud and related terms. Fraud is an intentional act involving the use of deception to obtain an unjust or illegal advantage, essentially theft by deception. Deception is an act or statement which misleads, hides the truth, or promote a belief, concept, or idea that is not true. Fraud is a criminal offense punishable by a fine or imprisonment. Second term is error. Error refers to unintentional mistake. Error is an inevitable part of human nature. So, systems of internal checks are essential in order to prevent or detect any possible errors. Third term is irregularity. Irregularity is something contrary to a particular rule or standard. Fourth term is misstatement. Misstatement is something stated wrongly. Misstatement can arise due to fraud, irregularity, or error. Let us understand the difference between the term learned above. Fraud should be contrasted with error. While fraud is an intentional act, error is an unintentional. For example, if a purchase ledger clerk deliberately enter a false invoice from a friend into the purchase ledger, hoping that it will be paid so that the clerk and the friend can split the proceeds. This is a fraud. However, if the clerk accidentally enter an invoice twice into the ledger, this is an error. An irregularity would occur if a petty cash system designed to limit individual vouchers to a less than 50 rupees but allowed a single voucher of 70 rupees to be processed. An example of misstatement may be when a balance sheet shows a building at cost of $1 million whereas the actual cost was $1.3 million. This misstatement could have been either a purposeful fraud or an accidental error. As far as the financial statements are concerned, fraud comprises both the use of deception to obtain an unjust or illegal financial advantage and intentional misrepresentation affecting the financial statements. It is ultimately up to the courts to decide in each instance whether fraud has occurred. For example, deliberate falsification of documents or records, deliberate ignoring of errors requiring correction, deliberate suppression of relevant information. Note that fraud may be carried out by management, employee, or third parties. For example, manager may deliberately select inappropriate accounting policies. Employees may steal the proceeds of cash sales and omit to enter the sales into the accounting records. Third parties may send bogus invoice to the company hoping that they will be paid in error. Let us know about prerequisites of fraud. There are three prerequisites that are required for fraud to occur. First one is dishonesty, relate to a lack of integrity or honesty. An honest employee will be unlikely to commit a fraud. Second one is opportunity. The individual must have the opportunity or opening for a fraud to be committed. These opportunities will often be created due to weak internal controls. Third one is motivation. The individual must feel that the reward that can be earned by the fraud will outweigh the potential cost if they are caught. All three are usually required. For example, an honest employee is unlikely to commit fraud even if given opportunity and motive.